Hey guys, Brett here with Springport Wealth Inc. I specialize in raising capital and finding deals, and it's my mission to help you do the same. Today in conversation we have Keith Uthe. He's a certified real estate investment advisor and wealth planner. He's also a licensed mortgage associate who specializes in commercial and residential real estate, and he specializes in funding deals from flips to apartment buildings to developments and anything in between. Today we'll take a little peek behind the curtain and look at real estate investing through the eyes of a lender. And we have a discussion around the lending environment and what it takes to get your deal funded. Hopefully this information is helpful and gets you well on your way to funding for your next deal. As always, if you like the information, I'd be greatly honored if you like and subscribe if you so choose. Now that that's out of the way, let's get to it. Hey guys, Brett here with Springport Wealth Inc. Thanks for joining me. Today I'm honored to have with me Keith Uthe. Anyone new to the game or experienced will definitely either know Keith or have worked with him, or if you haven't, you need to. He's a certified real estate investment advisor who specializes in wealth planning. He's a licensed commercial mortgage associate, and the counsel that he provides is focused on due diligence, financing, and underwriting. He's very well connected within the real estate investing community, and he's often featured as an expert panelist on the RAIN stage. He's won many accolades, among them the Southern Alberta Innovative Investor of the Year and the Dragon's Den Business Plan Scholarship Award winner. He's also heavily involved in wheelchair basketball throughout Canada. I know it's something that he's very proud of. And we're also very honored to have him with us. So everybody out there in virtual land, please help me welcome Keith Uthe. Thanks, Keith.
Thanks, Brett.
Yeah,
Thank
great to have you here.
me.
An absolute pleasure, an absolute honor, and thank you for blessing us with your time. And happy to have you here.
You're welcome.
Awesome.
Glad to help.
Yeah, thank you. So what I wanted to do is kind of just start off, for those who don't know you, and maybe those who know you a little bit, is talk about kind of how you got here, tell a bit of your story, how you ended up as a licensed mortgage associate and a real estate investor.
Well, I'll start with the real estate investor. So my wife Nancy and I began real estate investing in 2003. And it actually started by us buying a condo for my mother-in-law to move into and live in as a renter with a fixed rent that she could pay. Rents were just starting to really see increases unrestricted in Alberta at that time, and she was on a budget. And so that was our first investment property that we purchased. Since that time, we've done a flip. We've done joint venture partnerships with partners that we still have as partners to this day in the same properties. We've done lender take-back partnerships. We've purchased properties on our own. We've gone the corporation route with some properties, and we've sold properties that with investors that we had that have now retired and wanted to divest of their interesting properties. So that's where our real estate experience began. We became members of the Real Estate Investment Network in 2011. That was after about 5 or 6 years of spending money and trying other programs and some other coaching, none of which have lived up to anything like what RAIN has done for us. RAIN really taught us how to treat real estate investing like a business, and really how important the economic fundamentals are in the determination of what you're going to invest in. My experience for becoming a licensed mortgage associate, that happened after having been working as a underwriter at a private lender here in Calgary. And that after, when I left there, I reached out to a good friend who introduced me to a couple of different mortgage brokers, of which one is who I've been with now for almost 4.5 years. So, and in that time, I've been fortunate to be on through Mortgage Alliance, which is the franchise that I'm associated with, I have achieved the master's level for the last 3 years, 3-4 years in a row that I've been a mortgage broker. So that is I've been able to achieve that way. Through RAIN, I've also been the Real Estate Professional of the Year in 2017 and 2019 as well for them. So it's something that is passionate for me. My personal vision is everyone shall live a life of abundance. And so I endeavor to fulfill that every day by finding a way to have an impact on people's lives.
Well, love it. I mean, not much to add there. That should be on your headstone. So, very interesting how you spoke about starting over at a private lender. And from what I know, they were focused a lot on flips, if I'm not mistaken.
Yeah. Well, you know what? That's just one of the products that they offer.
Okay.
Out of the many things that they did, that was one of the market niche products that they had.
Right. So for those who don't know, could you maybe delve a little into that, talking about the traditional, excuse me, if there is such a thing, a traditional flip lending product, and how would someone obtain financing for a house flip? And maybe talk about, the down payment, the typical financing rates and things like that for someone who's looking to get into that sector.
Yeah, so your traditional flip lending product is going to require a 20 to 25% down payment. And it's likely going to be through a private lender or a B lender, depending on the current condition of the property and the extent of the renovation that is being done. If you are going to take a property down to studs, you're going to be dealing with a private lender. The B lenders will take stuff that is currently livable, and you're doing a moderate renovation to it. And they have some great products out there with some great rates. However, they don't necessarily apply to all instances.
Right.
And so you're looking at your down payments, 20 to 25%, and they're going to base it off of your purchase price, not any kind of after repair value. The specialty flip lending products will use after repair value. It can be for as little as $10,000 down, but you're going to pay an interest premium for getting access to that type of product, because the risk the lender is taking is much higher. Right. The higher the risk for the lender, the higher your costs are going to be. However, your rate of return can also be much higher because you're leveraging your capital more.
Right. So important for people to note out there, there's not a one size fits all. It depends on the deal. And that's why you want to always speak with a broker who has access to those kinds of funds and lenders to kind of package it specifically for you and your deal and your situation. So that's great information, Keith. Thank you.
You're welcome.
Yeah. So what would you be looking for? Say someone was to bring you a deal. What would you be looking for from the lender as far as, say, maybe experience, track record, credit score even? What kind of things are you looking for, not for the deal, but actually from the actual lender themselves? Because you hear a lot of things about you don't always need the money or zero down, but in the real world, things are a little bit different. So, what you usually be looking for?
So there's two parts to every deal that in the type of deals we're talking about. There's the client and the property that they're bringing, and then there's the lender that's going to fit what the client is asking for. Mm-hmm. And there is a risk that the wrong lender can put the client in a position that they aren't going to be able to get out of. So understanding, that's why that risk tolerance model is so important. So if a client brings a property that they've got to a point where it's so over leveraged, too over leveraged, that the lender can't because of the lending that they've gotten maybe before, so maybe they owned this property and now they've gone to private lenders, and those lenders have enabled them by leveraging them to high loan to values, and now they're finding that the affordability on that loan or loans are not possible. Well, now the exit just isn't there for going and finding another lender that could actually bring that down because they're over leveraged, and so when I look at lenders, sure, yeah, the lender might offer 85 or 90% loan to value to a client, but is that actually going to help the client with what their strategy is?
Right.
Because if their strategy is to try and take this property and do some work to it and refinance it, but they're leveraged at 85 or 90%, are they going to actually be able to increase the value enough so that we're going to be down below 80% or less to try to get when the time comes to try to refinance it? Right. So using minimal down payment and over leveraging a property can get a client into huge problems. And there are more what I'll say are hard money lenders. They're not mortgage investment corporations. They're not registered MICs or anything like that. They're people who just have money who say we'll finance you, and they may offer they may be willing to go to highly leveraged at higher interest rates, and those can end up causing problems for investors because they end up in a position where they then can't get out of it. The only option is to sell the property, and maybe selling the property at a loss.
Right. Yeah, and that's a great thing you touched on, because that was actually another question of mine, which was, and it's important for people to know the difference between an actual hard money lender or a MIC and a private lender. People think they kind of seem to go together, but they are all vastly different. Can you touch on that a bit?
Yeah. So your private lender and your MIC are pretty much the same, in that they're going to be someone who does it as a business on a large scale. They generally lend millions of dollars in business annually. They have looser qualification processes, but they're going to evaluate risk differently and have some policies around how they evaluate risk. A hard money lender likely is not going to have some of those policies in place, and they're strictly going to look at it from the security of the property based on its location and the potential that if they have to take it over, are they going to be able to recover what they have lent on it. They're generally going to charge more in interest rates, and they're generally going to be much more inflexible when it comes to the repayment of their funds.
Mm-hmm. And that's a good point to know. And for people who aren't familiar, what kind of rates do hard money lenders and private lenders, what kind of rates do they usually charge?
You know what? It's deal dependent.
Right.
So every deal is different, and most private lenders and hard money lenders will price it based on the deal that's presented to them, looking at the risk, the credit, what does the client have for supportive income? Do they have a full-time employment and they're doing something that's on the side, or is real estate their full source of income? And what's their risk exposure in that realm? How do they manage their credit? How much debt and liability they have? Those are all factors that they're going to look at for their financing. I mean, I can tell you that interest rates could range between 8% and 16%. But I mean, that really doesn't tell you much as far as being able to plan. It's really client and deal dependent.
Right. But that alone itself does help for people who aren't aware of what they can be expecting to deal with. So that range is even very helpful. So
and loan to value is another factor in that, right?
Yeah.
If you're willing to only have 65% loan to value, you're likely going to be able to get a much better rate than if you're looking to get 80% loan to value or 85 or 90% loan to value.
Understood.
And in the current environment we are in today, as we speak, and we're doing this during the coronavirus outbreak, the ability to get 85 and 90% loan to value, very limited, almost next to none, because the private lenders and stuff are so risk adverse as to what's going to happen in the real estate market.
Right. And that's a great that you touched on that. That was a question I was going to ask you. And since we're going in that direction, we might as well jump there now. Talk a bit about what the environment is like out there as far as lenders are going. What are you seeing? I feel like the belts are probably tightening up a bit, but maybe dive into that a bit.
Well, so there's the residential market and there's the commercial market.
Yeah.
So on the residential side, we're seeing still seeing purchases happen. We're still seeing refinances happen. I mean, you remember the large percentage of our population is still working, although they're working from home.
Yeah.
And some are working in a lesser capacity, or maybe they've had a reduction in their employment income, but they're still employed.
Right.
So on that side, the lenders are, being more diligent with their check for employment. If you're business for sale, what type of business are you operating? How does the current economic environment impact your business? Looking for more recent and updated statements for businesses. If you have rental properties, confirming, have your rents been paid? By asking for bank statements, which is, maybe another step that they wouldn't have asked for before.
Right.
So that's on the residential side. On the commercial side, it's just taking longer for them to do their diligence. They are still looking at deals, but some of the lenders have added another layer of review on files when doing their diligence. The biggest mistake that I find investors make is they're looking at buying commercial property and they end up talking or dealing with a residential realtor that doesn't know and understand commercial financing and what that's going to take and how long it's going to take. And they end up coming with a contract that has residential financing condition dates of only 7 or 12 days or whatever, when in actual fact right now, anything less than 4 to 6 weeks for the financing condition is not even possible. It's next to impossible. Especially
that's a golden nugget.
CMHC.
Yeah, so that's a golden nugget, everyone. What you just got. If you don't get anything out of this, take that home and take that to the bank, pun intended.
Yeah, work. You need to work, and as much as your aunt, your uncle, your best friend might be a realtor, if they're a residential realtor and don't have experience in commercial, and they want to try to help you, I do one of two things. Either work specifically with a commercial realtor and ask them to refer you to one so that they can get something out of it, or find a commercial realtor that they would be willing to work together to help make your deal happen, so that maybe they get some experience in that realm if that's what they're looking to do. If they're looking to just do your deal as a one-off, then probably better to have them refer you and negotiate a referral fee with a commercial realtor than anything. Better to make sure the deal is done right than to worry about upsetting family. And that's such an important. And then on the other side, if your family member is a commercial realtor and you're looking to buy a residential and they don't really know how to do residential deals, same thing works the other way.
Yeah. Another good nugget.
Yeah, there are some realtors that are licensed in both and do work in both realms.
Yeah.
But if that's not who your aunt, uncle, cousin, brother, sister, friend is, be aware that what the implications can be by not having someone who's up to speed on everything that happens in that type of deal.
Yeah, and then in the real world, we've seen that. We've been privy to some information sometimes where they have gone the wrong route with the wrong professional or wrong service provider who doesn't understand the sector or the realm, and then gets bad information, and then you're behind a shotgun the whole time. So that's great info. So and kind of jumping into the apartment building or the commercial section, we would call it. But maybe dig into that a little bit, because there are going to be a lot of people who are interested in that, who have either done it or are about to or want to in the future. And explain a little bit of the differences, especially because your specialty is financing. Dig into that a little bit, how they can prepare.
So the biggest thing is to know that financing on residential is completely different than financing on commercial. Mm-hmm. So the rules that apply to both are different. So residential financing, timelines are shorter, rates are generally lower, and the qualification process is based more on you personally than it is on the property. Go over to the commercial side, timelines for approval are longer. The qualifications are different because they're first going to look at the property and depending on what the type of property is it a owner-occupied commercial or is it strictly a investment commercial? Is it multifamily versus condo bays or a light industrial building or something of that sort? Then they're going to look at you personally. What is your credit? What does your credit history look like? What is your experience or background in investing in real estate or knowledge of commercial real estate? How are you going to be able to provide backup support if there's a financial issue? So your net worth comes into play, and they'll look at what you do. What is your career been? Right? They're going to basically kind of they're going to ask you for a resume or a bio of who you are and what makes you think you can be successful in investing in commercial real estate. Then the other part of that is the upfront costs. And in residential real estate, your upfront cost is really maybe just an appraisal, if that's needed, depending on commercial real estate. You've got a commercial appraisal, which is much more expensive. We're talking in the thousands of dollars, not hundreds of dollars. You've got lender and broker fees that have to be paid because there's no commissions paid to brokers or associates from commercial lending. There's also building condition assessments, which you may need to do. And there could be environmental assessments that need to be done. So, and then the legal fees in commercial lending, you pay both the lender's legal fees and your own legal fees. So again, those costs are higher as well. So those are again thousands of dollars more. So it's very quick and easy to say that on a $1 million commercial deal, it's very easy that you need to be able to afford and have the money for upfront costs of $30,000 just to cover upfront costs. That doesn't include your down payment.
Yeah.
Now,
valuable info.
Yeah, and so in the multifamily realm, there is two different avenues you can look at for financing for multifamily buildings. So we're talking buildings of more than 4 units.
Yeah.
And there are some 4-unit or even 2-unit buildings that might be on a commercial zoned piece of land that could be done commercially, but generally more than 4 units, so 5 or more, are commercial financing, multifamily, and those can be done through CMHC. So that's an insured mortgage, or through a standard commercial mortgage. Now, with those 2 different mortgages, one takes longer than the other. CMHC takes much longer than the standard. CMHC does offer the opportunity to go up to 40-year amortization, depending on the remaining economic life. On the standard side, you're looking at a maximum of 20, maybe 25 years. Interest rates, CMHC is going to offer you the lowest interest rate. Standard mortgages are going to be higher by 1 to 1.25% from CMHC. So here today on May 11th, CMHC, we're probably in the neighborhood of 1.7% for an interest rate. Standard mortgage, we're looking at for a fixed rate right now we're 3% or higher, because of the current cash crunch and how money is moving in the world. The commercial fixed rates are actually higher than some of their variable rates right now.
Yeah, and that's another thing I wanted to touch on, because when people are looking into this, especially on apartment building or multifamily investing, there's a few little things down the line that they may not realize that they need to set up right from the get-go. And it comes down to track record. And talk a little bit about, if you don't have your net worth, bringing in a net worth partner, or I should say, explain what the net worth requirement is for those who don't know. How does that usually work?
So when they talk about net worth, they're going to look at what do you have for cash in your bank accounts, what do you have for investments, and what do you have as far as even property that you own. Your cars, not really, although they'll be in there, they're not really going to look at your vehicles as being that much net worth. So those are really the main things that they're going to look at as far as what kind of net worth do you have to support in the event that something could happen to the building. So that's and then and part of what overcoming some of the net worth could be your experience, right? If you've got a lot of experience in investing in real estate but don't have as much net worth, you might be able to offset some of that risk because of like, well, you're going to better know how to manage and take care of the properties on a consistent basis versus someone who's got no experience and isn't going to maybe know some of those management tricks or management experience that needed.
Yeah, great. Yeah, and so based on your experience, and I'm sure you've seen all kind of funky things. Are there kind of standard, typical things that you can let people out there know what to avoid? What are typical mistakes that are made that could set them apart? Because immediately when you see an application, you can tell whether it's better or worse than others. Other kind of standard things that maybe people should keep in mind and even prepare so that it helps their chances?
So there are. So I'm going to use the word fiasco. Okay. If your financial picture looks like this to you, and you can't describe it and get through everything in a very organized fashion to explain it to me as your mortgage agent, then that means trying to explain it to a lender is going to look the same. Yeah. And so why would they have any interest in working with someone who's got a disorganized financial life? So you need to be prepared to have your documents and your financial life in order and understand. Like if you're self-employed and you have one or two or three corporations, you need to be able to know how to explain what each corporation does. How is one related to the other, or is it not related to the other? Why do you have three corporations, and why is one corporation doing management for another, or whatever it is? You need to be able to know and understand that. If you've been changing accountants on a regular basis, you need to be able to know and understand and explain, well, why have you been changing accountants on a regular basis? Because that's, like, what's going on? Are you difficult to work with, or are you not good at doing diligence on the people that you're working with? So no financial fiascos. Is what I say. If you have a financial fiasco going on, that needs to be cleaned up before we are ready to present anything to a lender. And if you come to me with an offer and you've got a financial fiasco, how much time are we adding to the approval time? Because we can't present something that's disorganized to the lender for them to even consider. All we do is eliminate that lender. Yeah. Or lenders, because they're going to go, well, this is disorganized.
Right. Yeah. So talk a little bit about maybe a really bad one that you've seen and a really good one. Some kind of horror stories and something to kind of set people off on an inspirational track, if you will.
Yeah. So the bad stories are kind of what I was just talking about. They've got lots of have been leveraging and using lots of unsecured debt. Have maybe multiple companies or multiple loans with different companies, and they're highly leveraged. They're changing accountants or changing bookkeepers, and there's been mistakes made that haven't been sorted out or straightened out, that they don't even know what was done to be able to explain what the mistake was, those are things that are common. They've decided that they're going to use it if they own rental properties or even their personal property. They decided to do accelerated payments, and those accelerated payments now increase their debt servicing because they've increased their payments. Now that impacts debt servicing, so it impacts risk and impacts how the application looks. So there's things like that can be bad deals. Overpaying on a property because they just want to get into a property. That's as far as the deal itself. This is where not working with an inexperienced realtor could create that. or working with a realtor who's just looking to, even that has experience, but is just looking to get you into a deal.
Yeah.
And as opposed to getting you into the right deal.
Right.
Those are ones that get in trouble, because then when the lender comes back and goes, well, this deal doesn't, the financials for this deal don't support the purchase price, like this, the cash flow doesn't look like it can cash flow, then now that's where the frustration kicks in. The realtor's going, oh, well, this property cash flows, look at the number. Well, but there's things missing from financials that aren't there or whatever. So those are bad deals. A good deal is one where the seller is ready and prepared to provide all of the information that you need to buy that property. So they've got their financials, they've got their taxes, they've got their renovation or their renovation or maintenance expense history of what they've spent. They've got their rent roll ready. They are prepared to sell, and you can do a proper financial evaluation of that property to determine whether it makes sense for you or not. And then the lender is going to be using those same financials for their determination. You've got your documents are in order and ready to go. You've talked to a mortgage broker up front so that they have an understanding of your financial picture, and the package that can be put together to the lender is great.
Right. Okay.
So that's the difference. Yeah.
And it just sounds, one sounds frantic and one sounds calm.
Yes.
Yeah. That's how I take it.
So one of the problems that people run into is buying from a seller who does not have or does not keep good financial records.
Yeah.
Those buildings are really difficult to work with and to finance because there's not a good financial history there.
Yeah, especially if they're self-managed.
Like on commercial, like on non-multifamily commercial, looking at the leases that are in place.
Yeah.
Right? What do those leases look like? That's an important factor. And are they available? That's key. Because that's one of the keys the lender's going to look at.
Right. So, I mean, that's something for everyone to take note of. Is try and be as clean and have your house in order before you even send it out, which means before you even look for a deal. Maybe that's something you should do.
Yeah.
So that you're prepared. Start with the end in mind.
Yeah. Talk to the mortgage broker. Get your personal side set up, and then make sure you know when it comes to looking at the property, what information you need to be making sure your realtor is getting for you and is including in the contracts are pretty clear, but you can even make sure that you're requesting the timeline and deadline that you're giving the seller to provide that information to you.
Yeah.
That's crucial.
For sure. And, there's something to be said about doing a lot of heavy lifting up front. So it's a little easier at the end.
Yeah.
So that's another thing. Now, if someone was just starting out, Keith, say in real estate investing, and especially now in today's climate, things have changed a bit. So say going into the last half of 2020, what would you say investors should be doing right now?
So one, they should be getting if they want to get into investing, down market is the time to be looking to invest.
Yeah.
So that means preparing, getting yourself personally prepared. Do you have all your documents ready for, your current mortgage statement, your current property tax statements, your bank statements, your employment pay stubs, knowing how do you request an employment letter from your employer during this current environment. What maybe was a 24 or 48 hour turnaround could be a 72 to 96 hour turnaround, right? So be aware of those things, because those are documents you requested. Have you filed your taxes? Do you have your T4s? Do you have your NOAs? Do you have your T1s? Depending on your financial situation. And that's where speaking with a mortgage broker up front and setting out a plan with them, you can get your package much better prepared. So that's what investors should be doing. And then they should be looking out and keeping an eye out for opportunities based on the economic fundamentals and their financial goals. If they haven't started a discussion to know and understand what their financial goals are, they need to know that, because then not only me as a mortgage broker or you in your role when working with them, we can better help advise them on properties that they bring to us as to whether or not they fit with what they're hoping to achieve. So that's what the investors should be doing.
Awesome. Good stuff. And I want to go back a little bit here and ask you as if you were just about to start out. Okay, it's always different from when you start than when you end or you're in it. It's different being in the ring, so to say. But say knowing what you know now, okay, and you're talking to a younger Keith, and he's gung-ho, ready to get into real estate investing. And if you only had to give yourself one piece of advice, just one, what would it be?
I would have taken the time to talk to more professionals as far as realtors, mortgage brokers, and lawyers, to make sure that I was having people on my team that were the right people for me to build an investment portfolio with.
Side note question on that, do you mean as far as being involved in real estate investing itself? Is that where you're going?
As far as, well, investing in real estate for sure. Yeah, because that's in us talking about real estate and investing in real estate. Those would be three keys towards knowing to what I know now to what I would have done then. Yeah. That would have been one of the key. Those would have been three of the key people that I would have talked to, and then getting them to introduce me to people that could have helped with some coaching in investing in real estate that was local to where we were, as opposed to coaches that are out of the US, as an example.
Absolutely. And those are two things I want to touch on for sure. I always talk about your team, and that's a key component, and it cannot be understated. You know, there's so many cliches about it. Your network is your net worth, or the other way around. You know, rising tide lifts all ships, all that kind of stuff. But what it basically comes down to is your team, and I'm so glad you touched on that. And another thing that I love that you talked about, because me, myself, I know you have as well, we've all used coaches. You know, the path has been laid out. It's funny, in our previous conversation, you mentioned don't reinvent the wheel, right? And a lot of it comes down to working with coaches who've already been there and done that. And you just have to follow the path, just walk the yellow brick road, as they say. Touch on that a little bit, Keith.
Yeah, it's so important to leverage the knowledge and experience of other people. And that's what you get in working with realtors that have the proper experience, working with mortgage agents and mortgage brokers that have the proper experience, working with coaches that not only are just trained in being a coach, but are also real estate investors, if that's what you're doing. So those are critical things to know and understand, because that is such a place where you can get into trouble. Having someone coach you that doesn't know what it is that you're trying to do and accomplish, you can end up spinning your wheels, and you actually end up getting the information, knowledge, and support that you truly need to move forward.
Yeah, absolutely, and I love that, and I can only second it, and that's a key factor. And anyone who's successful, if you ask them about it, a majority of them will absolutely say they've had some kind of a mentor or coach that led them down the path to success. So I'm so happy that you mentioned that. So I just wanted to kind of end it there and say thank you so much for everything you've provided here. It's been great, real world information. It's a little bit behind the curtains look, because a lot of times people don't see that. So that's why I wanted to talk to you, to get a little bit of what it's like kind of with an underwriter or a mortgage agent at their desk when they see a deal, so that when people are out there looking for a deal, they see what's going to happen in the end and what they're actually looking for, and it helps their chances. So I just want to thank you for providing that valuable info, Keith.
You're very welcome. I am happy to have the chance to speak with you and be able to help those that you know, and those investors that I don't know yet. So awesome. Anyone that wants to be able to reach out and connect with me can do so. My website is www.demystifyingmortgages.com is my mortgage website. My email is keith@enrichmortgage.ca, and my phone number is 403-614-8843. And you'll find me on Twitter, Facebook, LinkedIn, Instagram. Just use my name.
I love it. And I will say, from personal experience, Keith is always available. Sorry, Keith, to do this to you, but he's available. He'll communicate like it's nobody's business. So just a little just a personal plug there. So yeah. So I'll put all the links for your information and your contact info at the bottom of this video. And please, anyone, reach out to him. You could not be in better hands. And from behalf of myself over here at Springport Wealth Inc. and from Keith, we just want to say thank you guys and happy investing.